Welcome to Kitco News. I'm Niels Christensen. Joining us today is Andy Hecht, creator of the weekly Hecht Commodity Report and one of the top writers for Seeking Alpha. Thank you very much for joining us today, Andy.
Thank you so much for having me, Niles. It's always a pleasure to chat with you.
So let's jump right into it. What makes you a long-term bull in silver and gold?
Well, Niles, look, the short term, we're in a tough situation here with coronavirus, lots of volatility, deflationary spirals, stimulus, all kinds of things going on. But if I take a step back, a giant step back, and I look at comparing this to the last major event that we saw in markets, that you go back to 2008, the financial crisis, and I see a lot of parallels between what's going on in gold and silver between 2008 and 2020. So what happened? We had the initial push to the downside. Silver got pushed down to $8.40 in 2008. We recently got pushed down below $12. Gold got pushed down, really hard in 2008, 681. But that was at the time that it was headed up to the all-time high that was, below $900 an ounce. In 2008, the U.S. Fed, all the central banks around the world, they put lots of stimulus into the system, and it led to an overall rally in commodities. Gold and silver particularly did well. Gold got up to $19.21 an ounce. Silver got up to almost $50 an ounce in 2011. Now let's look at a couple of parallels here from the fundamental side. From July to this through September 2008, the U.S. Treasury borrowed $530 billion. Last week, the Treasury Secretary announced that they would be borrowing $3 trillion, over 5 times as much. For the period from March to now, and they'll probably have to borrow more. So the bottom line is the money supply is growing dramatically, and that's bullish for gold and silver, and it's bearish for fiat currencies.
It feels like 2008, but on steroids. I mean, we've seen, unlimited quantitative easing. What prices are you looking for? I mean, if there's similarities to 2008, I mean, do we just crash through the 2011 all-time highs?
I think we eventually, the answer to that, the short answer is yes. I just wanted to bring up two other parallels. Very important, very interesting. In 2008, the silver gold ratio spiked up to about 77.4 to 1, all right, before it went all the way down to 38 to 1 in 2011. We recently saw it get up to 124 to 1, which was an all-time high. So, on the deflationary knee-jerk reactions from the crisis, that's, I see the parallel between now and 2020 and 2008. Now, move forward to 2022, 2023. I don't personally think we'll have to wait that long. I think we're going to have a very similar move to the upside. Citigroup, before this happened, said 2,000 on gold. Bank of America said 3,000 on gold. I think we could see higher. I mean, I can't put a top on it, but I do think we'll see easily, over 2,000. And I think that over 3,000 is not a far reach. Silver, a little bit more difficult. Silver will go up with gold, but silver depends on, the industrial aspect of the whole thing here. So, silver needs to break out above $21 now. That's the only way that the herd is going to come in. Silver's all about sentiment. Gold is a currency, but silver's all about sentiment. So we need to see the technical break. And I view that level as 2109.50, which is the high from 2006, I think it was 2016, post pre-exit. So that's the critical level on the upside. But I think that they're behaving much like they did in 2008, and I think that they're going to react to this stimulus. The bottom line is this money supply is growing at the fastest rate it has ever grown in history. Central banks can print currency to their heart's content. You can only extract. They can only increase the supply of gold and silver by extracting more from the crust of the earth. That's the basis thesis.
Obviously, it sounds like you like gold more than silver, but do you think, like, in the long term, do you think silver, just because where we see the ratio and how elevated it is in the long term, does silver have a little bit more room to run?
On a percentage basis, silver always has more room to run. I like gold as a long-term investment. I like silver as a trading sardine. When I'm going in there, if I want to buy on a dip, it's silver I'm going to be buying because I think that that's the one that moves the most on this percentage basis. But when it's coming to long-term investment, gold is what I want to hold for a couple of reasons. First of all, it's got a lot more value in a smaller package. So, it's easier to store under my mattress or wherever I'm going to put it. But all kidding aside, it's the metal that central banks hold as a reserve asset, a reserve currency. So, I'm not going to ever fight the central banks of the world.
And we were also talking offline, and you said that there are 4 key lessons that traders and investors should learn from what we saw in April. I mean, we saw manic moves in commodities in April. So, I mean, what are the 4 lessons that you think investors need to learn?
I have to say, we learned a lesson. The oil market, which is the most liquid market in commodities in the world, and I worked for Fibro for many years. I worked with Andy Hall, so oil. I had a lot of experience in the oil markets, and I think we learned 4 key things. Number 1, zero can be a high price. I mean, we saw oil go to negative $40 a barrel. Now, gold's not going to go below zero. It's not that kind of thing. But other commodities can, so you got to be careful, and it's all about storage. If you can't store it, you got to pay someone to take it away from you. So, zero can be a high price in a commodity. The second thing, very important for those of us who trade options, the risk on a put option is not necessarily limited to zero. That could be a very, very bad, very troubling mistake to make for traders. So, the risk reward, we have to tweak our models a little bit, in terms of the options. The third is to always expect the unexpected. Always question. In the world of commodities, whatever the commodity, in the world of markets, expect the unexpected. You'll never be disappointed. And finally, never say never. Whenever I hear someone say never, Niles, it tends to give rise to a risk position because never loves to happen in the world of markets.
Okay, on that question then, I mean, do you think we see negative interest rates? A lot of people are saying, well, the Fed will never go negative on interest rates.
Never say never. When it comes to interest rates in the Fed, listen, this is an unprecedented time. The fire cannons are out. They're spraying liquidity everywhere. I would never say that they'd never go into negative territory. They could go into negative territory. First of all, we have to understand one thing about the interest rate market. The Fed controls the short end of the curve. The long end of the curve is controlled by market forces. So when the market forces operate, let's say never.
I think that's fantastic. I want to leave you with the thought that if somebody is going to pay me to hold gold, I will take that trade all day long.
When it comes to corn, soybeans, wheat, all of these other industrial commodities, if you can't store them, you can't own them. You have to get rid of them. And if you're in a risk position, a lot of people bought oil on April 20th, the May contract at zero. They thought they were geniuses, and they wound up bankrupt. So, just be careful out there. That's the takeaway.
Thank you very much for talking with us today, Andy. It's always a pleasure speaking with you.
My pleasure.
Thank you for watching Kitco News. For the latest information in the precious metals markets, go to kitco.com. Stay safe and stay healthy.